Welcome to another episode of A Quest for Twice. Today is February 22nd. I'm going to cover a few recent earning updates from companies in my portfolio. The first one is Equitrans midstream. The management provided the guidance for CapEx in 2023. For gathering system, it's about $260 million plus minus $25 million. For the transmission systems, the CapEx this year is about $95 million plus Mountain Valley pipeline expenditure. It is higher than the CapEx in the last few years because Equitrans is on track to start construction of the Ohio Valley Connector expansion project in this summer. So that's a growth opportunity is being realized. And for water system, CapEx for this year is about $40 million. The management also guided the estimated EBITDA for 2023 around $1.1 billion, slight increase from last year. However, this year's deferred revenue is slightly less than last year at about $285 million. As I mentioned previously, the gathering system CapEx is going to be less than $285 million. So that's slightly less than the previous estimated maintenance CapEx of $300 million. So in summary, my previous estimate of DCF about $0.7 billion each year is unchanged. It's more than enough to cover the forward dividend about $320 million a year and the necessary growth CapEx. At $6.15 per share, its EV over DCF is about 14.6. and the dividend is close to 10%. So I believe it is more attractively priced compared to my deep dive at the beginning of this month. So I built a small position in Equitrans. However, there is an update to the threat to DCF. In November, Equitrans found a leak from a well at its Range Mountain natural gas storage field. As a result, it incurred a charge of $8.2 million of last quarter to deal with the leak and related issues. The management had an estimate of another $8 to $10 million in this year because of that leak. So as I mentioned before, ETRN is heavily in debt with a low credit rating. So if any major accident happens, it will not have the financial resource for the additional loss or liability without the cutting dividend. The incident in last year at the Range Mountain is relatively small, so it's not a threat to its EBITDA and dividend. But it does show that it's a serious threat if a major accident happens. Energy Transfer also reported the fourth quarter earnings. Its full-year EBITDA for 2022 was $13.1 billion, slightly more than 2021, which benefited from the winter storm Uri. However, that need to be put in perspective of the acquisition Energy Transfer did in 2021. That was the Enable deal. So its net debt is slightly lower than the net debt level at the end of third quarter last year. Its 2022 DCF was $7.4 billion compared to $8.2 billion in 2021. That's an 8% drop because of a higher maintenance capital. However, if we look at the DCF per share, for 2021, that was $3 per share. And 2022 was $2.4. That's a 20% drop. The reason is because of the Enable acquisition, the shareholders became diluted. That's why the DCF per share dropped more than the absolute amount. For the full year, the capex was $1.93 billion in 2022. It's about $500 million more than the expenditure in 2021. Forward dividend is $3.8 billion. That's about 9.3% at $13 per share. Energy Transfer bought Woodford Express for $500 million last year, and gave a guidance of 13.1 billion EBITDA in 2023. That's about the same as last year, and $1.7 billion capex excluding acquisitions. So if we look at the DCF of 7.4 billion versus capex and dividend adding together, that's 5.5 billion. There is a free cash flow about $2 billion left, can be used for acquisitions as well as for unit buybacks. In my opinion, the best use of that is unit buyback. However, the management made no commitment of that. So that was disappointing, because the forward dividend yield is still very high. So I think the stock price is still undervalued at this point. INMD also reported the earnings. So for the full year 2022, its sales were $450 million, comparing to the initial guidance of $420 million. That's a growth of 27% year-on-year. The management gave a cautious guidance for 2023 at $530 million. That's less than 20% increase from 2022. However, the management tends to be very conservative, so I would not put too much weight on that guidance. I think that'll be raised. At $37 per share, its forward PE is 14.4, and EV over EBIT is 9.8. Given its robust growth trajectory, I think the stock price is undervalued around $38 per share. Upstart also reported the fourth quarter earnings. So for the full year 2022, its revenue was about $840 million. That's a drastic reduction from the initial guidance of $1.4 billion. That's because of the rising interest rate, reducing supply of funds. So that's showing up in the transaction volume of 1.5 billion in last quarter. That has been declining from a peak of 4.5 billion transaction volume in the first quarter of last year. So for this quarter, the first quarter of 2023, management guided a revenue about $100 million. So if we look at the chart on the right, that's a further reduction from the recent quarterly revenue of $147 million. That's about a third of the revenue in the first quarter of 2022. So the headwind from a high interest rate environment is still very intense. So can the growth return? There are some signs of hope. A good sign is the bank and the credit union partners continue to increase. So at the end of last quarter, there were 92 partners, comparing to 31 at the end of Q3 2021. And also, the number of auto dealers using Upstart's software has increased to 778, comparing to 291 at the end of Q3 2021. The hope is once the interest rate environment stabilizes, then the funding will return. so its transaction volume will rebound. If the interest rate starts to decrease, then there will be greater demand for credit. Then hopefully Upstart's transaction volume will take off in that environment, but only time will tell. The bottom line is if Upstart has a good credit valuation model, that will really decide its long-term growth trajectory. The small chart on the right shows Upstart's platform performance versus target. We can see that it outperformed the target in the last few years before the interest rate started to go up. In about 1 year ago, that underperformance peaked. Then for the last 3 quarters, that underperformance gap is becoming smaller and smaller. So that is a sign of validity of its credit model. Another update about the threats is at the end of last year, it carries $518 million of loan on its own book because of lack of external funding. So that's a significant increase from $140 million at the end of first quarter last year. However, the management stated that they have no plan to further increase its loan asset. Now a quick update to its valuation level. At $19 per share, its price over sales is about 1.8 compared to 13.6 at the end of 2020. So based on that metric, its valuation really has drastically reduced. If it has a good product, better than FICO, for example, then I think its market cap can easily become a 10-bagger from a current market cap of $1.6 billion. So it really comes down to the quality of its credit model. Right now, there are some promising signs, but no definitive answer one way or another. Only time will tell. Until next time, happy investing.